This page shows the big picture comparison between the three inventory costing methods, FIFO, LIFO, and weighted average cost. These three methods assume a cost flow when a company sells goods. The specific identification method is not included here because that method does not have a cost flow assumption. It utilizes an exact physical flow to account for cost flow. In times of rising prices, FIFO will sell or cost out the older units at a lower cost, leaving the newer units at a higher cost in ending inventory. This is in contrast to LIFO, which costs out the newer units at a higher cost and retains the older, lower cost units in ending inventory. The weighted average cost method, by nature, is an average of the FIFO and LIFO methods. I've taken the results of my example done under all three methods and included them in this table. You can tell by comparing the numbers that the weighted average method always yields a result that is in between FIFO and LIFO, and that is its intention. The weighted average method takes all of the unit costs and averages them out to a number somewhere in the middle. So if you don't get a number in between FIFO and LIFO, then you've made a mistake. Looking at the impact that these inventory costing methods have on net income, you'll see that FIFO provides for a higher gross profit and net income, so it's preferred by companies who want to show a high profit and income. LIFO yields a higher cost of goods sold and thus a lower gross profit and net income. LIFO would be popular for companies that want to report lower income and therefore lower taxes. An interesting note regarding LIFO is that this method of inventory costing is only prescribed under U.S. GAAP. LIFO is not permitted under International Financial Reporting Standards or IFRS. Other countries and other parts of the world don't use LIFO. Why then does the United States have LIFO when the rest of the world doesn't? Also, who uses LIFO? The answer resides in the oil and gas industry. Companies in the oil and gas industry are large multinational companies that report strong profits already. They are blue chip value stocks on the U.S. stock exchange with stable stock prices. As such, there isn't as much of a need to report strong earnings to boost stock price. Not that it hurts, but their desire to pay less taxes outweighs their desire to report high earnings. These companies use LIFO to lower their tax burden. Also, because these companies in the oil and gas industry are very powerful and have a very strong lobbying force in Congress, they are able to lobby to have LIFO as part of generally accepted accounting principles so that they can use it for their benefit, which is to pay less taxes. The last note on inventory costing methods here is that GAAP doesn't care which method a company chooses. A company can choose any of these four methods that we've talked about, or a number of other inventory methods that are prescribed by GAAP but that are not covered in this chapter. As long as you use a method, that's what GAAP cares about. And as long as you use the same method that you pick for both financial reporting and tax reporting, that's what the IRS cares about.